Welcome to GBS Analytics Hub. In this video we are going to cover one of the most important financial processes in any global business services or shared services environment, accounts payable and the purchase-to-pay process. Whether you work in finance, procurement, operations or analytics, understanding how a P works and how data can transform it is essential knowledge for any GBS professional. By the end of this video you will understand the complete procure-to-pay or P2P journey from start to finish. You will know the key terms every finance professional must understand. You will recognize the most common challenges a P teams face every day, and you will see exactly how Power by Analytics solves every single one of them. This is practical, real-world knowledge, built from over 20 years of hands-on experience in global GBS environments. Let us get started. Accounts payable, commonly known as a P, is the financial function responsible for managing everything a company owes to its external vendors and suppliers. Every single time a business purchases goods or services on credit, whether that is equipment, professional services, raw materials or office supplies, that financial obligation lands in accounts payable and sits there until the payment is made. In a global business services or shared services environment, the scale of a P operations is significant. We are typically talking about thousands of invoices processed every single month, across multiple countries, multiple currencies, multiple legal entities and multiple ERP systems. At that scale, manual processes simply cannot keep up. Errors multiply, payments get missed, visibility disappears. This is exactly why data analytics is not just useful in a P, it is absolutely essential. Without it, finance leaders are flying blind. The purchase-to-pay process, also known as P2P, describes the complete end-to-end journey from the very moment a business decides it needs to buy something, all the way through to the final payment being made to the vendor. It is called purchase-to-pay because it covers everything in between those 2 points. It is not just an AP process. It is not just a procurement process. P2P connects procurement, finance and operations into one single continuous workflow, and that is what makes it both powerful and complex. When the P2P process works well, vendors are paid accurately and on time, costs are properly controlled, cash flow is optimized, and the business runs smoothly. When it breaks down, invoices pile up, vendors complain, payments get missed, and finance leaders lose visibility into one of the most important areas of the company's financial position. Getting P2P right is fundamental to business health. The purchase-to-pay process begins with 2 critical steps that set the foundation for everything that follows. Step 1 is the purchase request. When a department within the business identifies a need, whether that is new software, manufacturing components, consultancy services or office equipment, they raise a formal purchase request. This document triggers the internal approval workflow and ensures that every single purchase is properly authorized before any commitment is made to an external vendor. Step 2 is the purchase order. Once the request is approved, a formal purchase order is created and sent to the selected vendor. The PO is the legal and financial commitment to buy. It locks in the agreed price, quantity, delivery terms and payment conditions. This document becomes the reference point for everything that follows. Every vendor invoice must later be matched back to this original purchase order before any payment can be released. The final 3 steps of the P2P journey bring everything together and complete the payment cycle. Step 3 is goods receipt. Once the vendor delivers the goods or completes the service, the receiving business must formally confirm that delivery has actually taken place. This confirmation, the GR, is a critical financial control. Without it, no payment should ever be approved. Step 4 is invoice processing. The vendor sends their invoice to the AP team. The team then validates that invoice, checking it for accuracy, completeness and compliance, and matches it against both the original purchase order and the goods receipt. This 3-way matching process is the cornerstone of AP controls and prevents the vast majority of payment errors, fraud and duplicate payments. Step 5 is payment. Once the 3-way match is complete and all approvals are in place, payment is processed and released to the vendor within the terms that were originally agreed in the purchase order. Before we look at the analytics dashboard, let us cover 3 key AP terms that every GBS and finance professional absolutely must understand. The first term is purchase order, or PO. This is the official document that formally authorizes a purchase from a vendor. The golden rule in a P is simple: no PO, no payment. Every vendor invoice must be traceable back to an approved purchase order before any payment is released. The second term is 3-way match. This is the process of matching 3 separate documents together before approving payment: the purchase order, the goods receipt confirming delivery, and the vendor invoice. When all 3 align, the payment can proceed. When they do not, The invoice is held for investigation. The third term is payment terms. These define exactly how long the company has to pay after receiving an invoice. Net 30 means 30 days. Net 60 means 60 days. Negotiating longer payment terms directly improves the company's working capital and cash position. Here are 3 more essential AP terms that drive financial performance in any GBS environment. The first is Days Payable Outstanding, commonly called DPO. This metric measures the average number of days a company takes to pay its vendors after receiving their invoices. A higher DPO is generally positive from a cash flow perspective. The second term is Invoice Aging. This is the categorization of all outstanding unpaid invoices into time buckets: 0 to 30 days, 31 to 60 days, 61 to 90 days, and over 90 days. Aging analysis is one of the most powerful tools in AP. It allows finance teams to identify payment risks and prioritize actions. The third term is Working Capital Impact. When a company successfully extends its vendor payment terms, say from 30 days to 60 days, it frees up significant cash that can be deployed elsewhere in the business. AP management is directly linked to the company's overall financial health and liquidity position. Despite being a critical financial process, accounts payable in most organizations today is still held back by 4 common challenges that cost businesses significant time, money, and vendor relationships. Challenge 1: Manual reporting. In the majority of organizations, AP teams are still spending hours every single week manually tracking invoice status in Excel spreadsheets. They are copying data from one system, reformatting it, chasing approvals by email, and rebuilding the same reports over and over again. This is not just inefficient, it is error-prone and completely unsustainable at global scale. Challenge 2: Late payments. When visibility into due dates is poor, invoices get missed. Late payments damage vendor relationships, trigger financial penalty charges, and in some cases disrupt the supply chain entirely. Challenge 3: No real-time visibility. Challenge 4: Duplicate invoices. Without automated controls, the same invoice can be submitted and paid more than once. This is where Power BI and data analytics completely transforms AP operations. Solution 1: Automated Status Dashboard. Instead of manually updating spreadsheets, a Power BI dashboard connects directly to your ERP or finance system and shows the real-time status of every single invoice. Paid, pending, overdue, disputed, all in one place. Updated automatically. Solution 2: Aging Alerts. The dashboard automatically flags every invoice that is approaching its due date. Solution 3: Vendor Performance Insights. By analyzing spend, dispute rates, and payment terms across all vendors, finance and procurement teams can identify their highest risk suppliers, negotiate better terms. Solution 4: Working Capital Optimization. Payment terms analysis across vendors and countries reveals opportunity of improved cash flow. The results from real-world deployments speak for themselves, as illustrated: late payments improvement, time saved, working capital gains, all with 100% accuracy. That brings us to the end of this video on accounts payable and the purchase-to-pay process. You now have a solid understanding of the complete P2P journey from purchase request all the way through to payment. You know the 6 key AP terms that every finance and GBS professional needs: purchase order, 3-way match, payment terms, days payable outstanding, invoice aging, and working capital impact. And you have seen exactly how Power BI Analytics addresses every single one of them with real measurable outcomes. In the next video, we are going to put all of this into practice. We will build a complete AP Analytics dashboard in Power BI, using real invoice data, showing exactly how these insights come to life visually for finance and operations teams. Make sure you subscribe to GBS Analytics Hub, so you do not miss it. If you found this video useful, please give it a like and share it with a colleague who works in finance or GBS. See you in the next one.